What if your mortgage could actually help you keep more of your money without you changing your budget? What if you could pay off your home years faster, save tens, even hundreds of thousands in interest without cutting back on your lifestyle? And what if you could pay down your loan with confidence, knowing you could still access that money anytime you need it for an investment, an emergency, or an opportunity? That's exactly what the all-in-one loan is designed to do. Here's how. You spend less money on interest without changing your monthly budget. It helps you shrink your loan balance day by day, accelerating your payoff timeline. You have 24/7 access to your equity, giving you the confidence to reduce your balance faster. And you get unmatched flexibility, handling life surprises or opportunities without starting over on a brand new loan. This isn't a theory. It's a proven system that's been working for over 2 decades. And in the next few minutes, I'm going to show you exactly how it works and why the safe mortgage you've been told to choose might be costing you far more than you think. Let's face it, most of us need a mortgage to buy a home. In fact, 80% of homebuyers need a loan just to make the purchase. About 62% of Americans today have a mortgage, and only 1 in 4 can pay cash. Why? Because houses are expensive, and interest rates drive affordability. When rates are low, demand goes up. When rates are high, demand cools. But here's the truth. We've been trained to ask, how low can I get my payment? Instead of, how fast can I get out of debt? That's why 90% of borrowers choose the 30-year loan. Stretch out the payments to make them affordable. Today, there's over $12 trillion in home loans in America. And instead of paying them down, most people refinance every time rates drop, resetting the clock, pushing the payoff further away, and paying more interest along the way. Here's the problem. By the time retirement comes, far too many people are still making mortgage payments. They've focused on the payment, not the payoff. So let me ask you, do you want a mortgage payment when you retire? Here's what life with a mortgage really looks like. Most people start a family around the age of 27. By 31, they're buying their first home. The average home buyer today is 47 years old, and the average mortgage borrower is 55. That means many of us are carrying mortgage debt right into our prime wealth-building years. Retirement arrives around 64. Life expectancy runs into the late 70s. That's a 50-year window where so much happens. Economic ups and downs, raising kids and paying for college, helping aging parents, battling inflation. But through it all, one thing doesn't change: the mortgage payment. And when rates drop, we're told to refinance to lower the payment. But every time we do, we reset the clock, which is why so many people still have a mortgage in retirement. Here's the truth. If you only focus on keeping the payment low, you'll stay in debt longer and pay more interest. If you focus on wealth building, you'll own your home sooner, save a fortune, and keep more money for the things that matter most. Let's talk about where your money really goes each month. For most households, about 55% of your monthly budget covers cars, groceries, utilities, repairs, student loans, entertainment, and maybe there's a little left over for savings. The other 45%, nearly half your income, goes to housing. And if you've got a 30-year mortgage, here's the kicker. In the first 8 to 10 years, 80 to 90% of that housing payment goes to interest. Not your equity, not your wealth, the bank's profit. Month after month, year after year, your single biggest expense is structured to benefit the bank, not you. The 30-year fixed loan was born in the Great Depression. Back then, adjustable loans were common. But when war and runaway inflation hit, payments spiked, incomes fell, and people lost their homes. So the government stepped in. The 30-year fix gave borrowers stable payments, low down payments, and predictability. For that era, it worked. But fast forward to today, the loan hasn't changed in nearly a century. It's a commodity product that most people pick without question. The problem? Today's borrower is very different. We have multiple income streams. We move more often. We face more financial uncertainty. And the 30-year fixed has serious drawbacks. It's slow, 30 years to pay off. It's inefficient. You can't access your equity without refinancing. It's rigid, the same payment every month, no matter what. And it's expensive, with interest front-loaded for years. Bottom line, the 30-year fixed was designed for a different time. It no longer aligns with today's needs for flexibility, efficiency, and wealth building. One of the biggest selling points of a 30-year mortgage is the same payment for 30 years. But here's the math hidden in the fine print. The way it's structured, the bank gets paid first. By year 10, for every $100 you send in, only $23 goes to principal. The rest, over 75%, is interest. By year 21, after 2 decades of payments, you still owe more than half your original balance. It's not until year 20 that you finally start paying more principal than interest each month. And every time you refinance to lower the payment, you restart the whole process. Now, let's look at the total cost. At a 6% rate, you'll pay 116% of your loan amount in interest over 30 years. For every $100,000 borrowed, that's $116,000 in interest on top of paying back the original loan. Even at 3%, you're still paying 52% in interest. This is why the banks love the 30-year loan and why it's such a slow, expensive path to wealth. When you strip it down, your mortgage payment is based on 3 things: interest rate, loan amount or the principal, and the term or the number of years. Together, they create your payment. A 30-year loan keeps your payment lower but drags out the interest. A 15-year or a 10-year loan pays off faster but forces your payment to be much higher. That's great if nothing ever changes in your life. But today, with job changes, market swings, unexpected expenses, the higher required payment is a real risk. And here's the kicker. Not only does your payment go up, but you lose access to your equity. That money is locked away until you refinance or sell. So the choice becomes lower payment with higher interest or faster payoff with less flexibility. But what if you could have both, payoff speed and flexibility, without giving the bank all that extra interest? This is where the all-in-one loan changes the game. It shrinks your balance day by day, paying off your home 2 to 4 times faster with no change to your budget. It cuts your interest costs by tens, even hundreds of thousands, without depending on rate drops or refinancing. It gives you 24/7 access to your equity so that you can act on emergencies or opportunities without starting over. And it builds wealth faster by keeping your money working for you instead of sitting idle in a checking account. One customer summed it up: open your mind to more than just interest rates. This product is about much more. That's exactly what the all-in-one loan is designed to do. A smarter way to use your income you already have to pay off your debt faster, save more, and build lasting financial freedom. Here's how it works. You get a brand new checking account with all the tools that you already use today. Checks, ATM, online and mobile banking, wires, even client services. But this account is directly linked to your mortgage. Think about this. In just 5 years, more money flows through your checking account than most people even owe on their home loan. The problem is, that money often sits idle, waiting to be spent. Weekly expenses, monthly bills, quarterly premiums, annual dues. And while your money sits there earning little to nothing, the bank is using it to lend to others. The all-in-one loan flips the script and puts your money to work for you the moment it hits your account. The secret weapon is called the sweep function. At midnight every day, idle money in your account is swept to reduce your loan balance. Since interest is calculated daily, the lower your balance is on that day, the less interest you pay. The math is simple. Balance times the rate divided by 365 days, and that's your daily interest. At month's end, we total those daily amounts. So even a few days with a lower balance saves you money. Instead of the bank profiting off idle cash, your cash is shrinking your balance every single night. And the best part? You don't change a thing. This happens automatically behind the scenes with the same money already in your checking account today. With the all-in-one loan, your money finally works for you, not the bank. One of the most powerful features of the all-in-one loan is liquidity. When you're not using your money, it saves you interest by lowering your balance. When you do need it to pay bills, credit cards, car payments, even taxes, you simply log in and pay like you always have. Behind the scenes, the system pulls funds from your credit line to cover the bill. No hoops, no delays. The only exception, Texas, where manual transfers are required. Everywhere else, it's automatic. Bottom line, when you don't need your money, it's working for you. When you do need it, it's right there, ready for you. That's the kind of flexibility a traditional mortgage simply can't give you. Let's bring it all together. The all-in-one loan gives you 4 advantages no traditional mortgage can match. 1. Faster payoff, shrinking your balance day by day. 2. Massive savings, tens or even hundreds of thousands less in interest. 3. Full liquidity, 24/7 access to your equity. And number 4, smarter wealth building, because your money works for you every day. That's the all-in-one loan. Faster, smarter, more flexible. And it's not a theory. It's a system that's been working for homeowners for over 20 years. Now, it's ready to work for you.